Welcome back, everyone. Today, we are tackling a big one, a really powerful risk management strategy straight from the world of options trading, delta hedging. Now, I know, it sounds pretty complex, but trust me, it's an absolutely essential shield for anyone looking to protect their portfolio from those wild market swings. So let's break it down. In the world of options, we use these things called the Greeks to measure all the different kinds of risk. But among all of them, there's one that really stands out as the main threat, the one that can flip a winning trade upside down in the blink of an eye. And that risk is delta. But today, we're going to learn not to fear it, but how to manage it. So here's our game plan. We're going to start by looking at where delta hedging even fits inside an investor's toolbox. Then we'll get right into what delta actually is and why it's such a wild card. From there, we'll get our hands dirty with the mechanics of how to hedge, the super important timing of when to do it, and finally, we'll see how it all comes together as the ultimate defensive play. Okay, let's kick things off with the big picture. Every single investor, I don't care what you're trading, needs a good set of tools for managing risk. Because, let's be real, the goal isn't to avoid risk. That's impossible. The goal is to manage it, to handle it intelligently. Think about it like this. We all start with the fundamentals, right? Proper position sizing, that is always your first line of defense. Then you've got things like diversification and stop losses. But when you get into options, you're dealing with multi-layered risks that just require more specialized tools. And that's exactly where delta hedging fits in. It's like the precision instrument for a much more complex job. I know what you might be thinking. Delta hedging. It sounds intimidating, doesn't it? Like something only Wall Street pros with supercomputers would ever use. And you're not alone in feeling that way. And yeah, look, it's got a few moving parts, but it is 100% learnable. Our goal here is to just break it down piece by piece until the whole idea clicks. So let's start with the absolute foundation. So what in the world is this delta we keep talking about? Well, the easiest way to remember it is this. D is for delta and D is for direction. At its very core, delta is all about the risk you have from the direction a stock's price moves. So, put simply, delta tells you how much your option's price is expected to move for every $1 change in the stock. You can almost think of it like a speedometer for your option. A high delta means your option is super sensitive to the stock's moves, and a low delta means it's less sensitive. And here's what that looks like in the real world. Call options, which, make money when a stock price goes up, always have a positive delta. See that plus 0.50? That means for every dollar the stock rises, this call option should gain about 50 cents in value. And on the flip side, put options, which make money when a stock falls, have a negative delta. It all just points back to that directional relationship. So if we strip away all the jargon, this is the one thing to burn into your brain. Delta is your position's sensitivity to price movement. It is your directional risk. That's it. And once you get that, managing it becomes a whole lot easier.
Okay, so we know what delta is, but why is it the big one? Why is it considered the main threat, more so than other risks like time decay or volatility? Well, it all comes down to one word: unpredictability.
Just think about it. Time decay, or theta, it's a risk, yeah, but it's totally predictable. We know exactly how much time is going to pass between today and tomorrow. But price movement, man, that is the big wild card. A stock can gap up 50% on an earnings report or crash on some bad news. It can move way more and way faster than anyone thinks is possible. And that raw unpredictability is what makes delta the #1 threat we need to get a handle on. So if delta is the unpredictable threat, then delta hedging is our defense. The source material calls it a price shield. And honestly, that's the perfect way to think about it. This isn't something you do when everything's going great. It's a specific, defensive move you make when your position is getting attacked by a nasty price move. All right, so how do we actually build this price shield? Well, the core idea is surprisingly simple. You fight fire with fire. You use an opposing directional force to completely neutralize the directional risk you're trying to get rid of. The whole process really breaks down into these 4 logical steps. First, you've got to calculate the net delta of your entire position. You need to know exactly what you're up against. Second, you figure out which way your risk is pointing. Are you going to get hurt if the stock goes up or down? Third, you pick your weapon, which is usually just the stock itself. And finally, you pull the trigger by creating an equal and opposing force to cancel out that risk. Let's make this crystal clear. Imagine your entire options position has a net delta of positive 26. What does that mean? It means you're long delta. You make money if the stock goes up, you lose money if it goes down. So your risk is to the downside. To neutralize that, you need an equal and opposite force, a delta of -26. And how do we get that? Easy. Shorting one share of stock gives you a delta of -1. So you just short sell exactly 26 shares of stock. The plus 26 from your options and the minus 26 from the short stock, they cancel each other out. And just like that, you're at zero. Your directional risk is gone. And that phrase right there sums up the entire mission. Hedging isn't about trying to make more profit or get rid of your original idea. No, it's a surgical move. It's about intelligently neutralizing your directional risk, making you flat so you can ride out the storm without having to abandon ship. Okay, this next part is absolutely crucial. Knowing how to hedge is only half the battle. Knowing when to pull out that shield, that's what really separates the pros. If you hedge too early, you can kill your profits. But if you hedge too late, well, the damage is already done. Timing is everything. You see, experienced traders don't just hedge on a feeling. They have a playbook with specific, predefined triggers. A really common one is when the stock hits your trade's break-even point. It's like a warning bell. Another is when the price starts getting way too close to your short strike. Some traders use something called the theta switch point, where time decay suddenly flips from being your friend to your enemy. And of course, a big one is when the stock breaks a major technical level, like support or resistance, signaling a potential trend change. So let's bring all of this together now. We've talked about what delta is, why it's a threat, and the how and when of building our shield. So how does this fit into a complete defensive game plan for an investor? Here's the bottom line, and I really want this to sink in. Delta hedging is an incredibly powerful tool, but it is not a magic bullet. It is not a substitute for the #1 rule of risk management, good position sizing. You have to start there. But when you combine that fundamental discipline with the tactical skill of delta hedging, that's when you get what the source material calls the best 1-2 punch for defending your portfolio. All right, let's do a quick lightning round recap. First, every serious investor needs a risk management toolbox. Second, delta is your risk from price movement, and it's the main threat you're going to face. Third, delta hedging is that price shield we use to neutralize that risk. Fourth, a hedge is simply an equal and opposing force. And finally, and this is so important, hedges are deployed at specific, predefined triggers. And that's really the idea I want to leave you with. You can never, ever eliminate all the risk in trading. It's just not possible. But that's not the goal. The goal is to manage it. So instead of asking, how do I find a risk-free trade? A much more powerful question is, how can I identify my single biggest threat? And how can I intelligently neutralize it when I need to? That mindset shift from just trying to avoid risk to actively managing it, that's what makes all the difference. Thanks for watching.